Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. After the US Federal Reserve, it was the European Central Bank meeting in limelight, and from a market reaction viewpoint, it was much more eventful. We saw a sharp rally in euro after a hawkish hike by the ECB, which says the fight against inflation isn't over. The Japanese policy decision is out, released just a few minutes back. They decided to keep policy rates unchanged. On the domestic front, India's merchandise trade deficit shot up to $22 billion against the $16.5 billion expected. Good morning, JK. How are you reading the ECB statement and take us through your thoughts on the Indian trade deficit? Can we expect higher deficit prints in the coming months?
Good morning, Swaraj. Yeah, we had two contrasting central bank decisions on two consecutive days. Now, look at it. Europe has a technical recession. Their leading indicators are pointing to more challenges for the economy, but ECB raises the rates and also confirms one more rate hike in July. US economy showing mixed indicators, including yesterday's data that showed retail sales improving, industrial production falling. The regional manufacturing index is steadier, and Fed goes for a pause and indicates data dependency for future actions. Now, both are focused on inflation target at 2%. One is ready to sacrifice growth while Fed is trying to balance it out. Now, President Lagarde somewhat deviated from the recent ECB strategy to stop forward guidance and have a meeting-by-meeting approach, as she pronounced a rate hike for next meeting in July. And she repeated the earlier phrase that ECB had more ground to cover. Now, Lagarde also remarked that ECB had not thought about a potential pause in its hiking cycle. And this is again one more contrast with the Fed. And Powell was more balanced and non-committal, as we have seen on Wednesday, about the future actions. He said the dot plot was not a plan for action, though it indicated another two hikes by the majority of the Fed members. Now, we won't be seeing a pause declared by the ECB either in July or September. And probably we need an economic earthquake in Europe to see them not to hike in September. Now, with these contrasting approaches, it's not surprising that the dollar was the biggest loser and the euro the gainer. It also appears that the market possibly does not believe in the Fed when they say there can be two more rate hikes. And for what market believes, there are data to confirm. Jobless claims again came elevated at 2,62,000 versus 2,45,000 expected. Import prices saw their shortest fall in 3 years. Then industrial production and manufacturing production were lower, both on year-on-year and month-on-month basis. Now, it was only industrial production that was lower. Manufacturing production was steadier. Now, this was reflected in the equities yesterday as Europe ended lower and US indices rose strongly again. Now, the yields also moved in opposite directions. As a result of the contrasting approach, we have seen yields in the two countries move, in different directions. 2-year German yield climbed 11 basis points and 10-year gained 5 basis points. By contrast, 2-year yield in the US fell by 6 basis points end of the day, although there was intraday volatility to the up and downside as well. 5-year fell by 7 BPs and 10-year now trades 6 BPs lower. Now, the German yield difference for 10-year paper has contracted with yield difference with the US for 10-year paper has contracted by 21 basis points, and that is reflected in the currency. The move lower in the US Treasury yield on the back of softer US data releases, plus the hawkish guidance from ECB has weighed on the USD, with the dollar index down 0.8%, influenced heavily by a strong rally in the euro from 0.813 just before the ECB decision to a high of 0.952 by US session close. And GBP was not far behind, rallying from 2.629 to 1.2792, with players anticipating another hawkish move from Bank of England next week. The rates in UK are expected to soon cross that of the Fed, who has gone on a pause at 5.25%. Now, USD made a cycle high at 141.50, but has ended lower at 140.27. Now reacted slightly higher again after BOJ held rates steady across. Now, it was the strong gain of 1.3% against the yen is, again, a very big move because the euro yields are moving higher and yen yields are steadier. In fact, yen has moved lower against the GBP as well as AUD. People again talking about reduced carry trades. Chinese yuan made a key reversal in yesterday's session after hitting a new high. The dollar gave up its gains in the last 3 days against the yuan to end almost 1% lower. Now, technically, this signals more losses ahead for the dollar against the yuan. Of course, there was some fundamental news to support this as well. After cutting their medium-term lending rate by 0.1% yesterday, China is planning more steps to revive its flagging economy, including possibility of billions of dollars in new infrastructure spending and looser rules to encourage property investors to buy more homes, as per the Wall Street Journal report. Now, as part of the stimulus efforts, Beijing is also considering issuing roughly 1 trillion yuan in special treasury bonds to help the indebted local government to boost the business confidence, as per the reports available. Coming to the Indian situation, USDINR actually has held very well above the support at 81.90. It was held on Wednesday after the Fed rate decision, and yesterday it opened higher. And again, 82.20 resistance was well respected, came down, but the trade data, which is disappointed by, again going about 20 billion for the month. In fact, net of, merchandise and services exports has also gone up by about 4 to 5 billion. Now, that's again a matter of concern. Now, we are not seeing any increase in exports because of slowdown seen in many countries. At the same time, due to domestic growth and consumption demand, the imports are increasing. So we are once again into the spiral of, rupee being subject to more pressure if there is no matching large inflows. So I think rupee stays its own course based on its specific fundamentals. Of course, we have seen large inflows in the last couple of days, and if that continues, we might well have rupee also perform. But according to me, the very strong support at 81.90 on a closing basis for a couple of days is crucial if it has to gain further. I think the central bank may not yet be ready to allow that to happen. Thank you.
Thank you, JK. And contrasting actions, but the same objective. I really was fascinated by the statement you used. It is a comparison between the US and the European policy decisions. Europe has a technical recession, but ECB keeps raising rates and confirms one more hike, while US, with a mixed economic performance, paused its rate hike. The narrative which I'm able to gather is that the market isn't believing when the Fed says 2 more hikes are possible. China, meanwhile, is planning more stimulus to prop up the economy, while on the rupee front, 81.90 continues to be a crucial support. We, of course, had some disappointing data from the trade front, coming above 20 billion for the month. That's it from us today. Have a very good weekend. We'll catch up again next week with another round of fresh updates. Thank you so much for listening.